Hello everyone, thank you very much for tuning in. Last week we discussed about inflation and how it occurs in general and broadly how it affects all of us. This week we're going to talk about the role of central banks and what are the tools available at their disposal to curb inflation and maintaining price stability. Before going into the topic, let's take a step back and first understand the reasons why central banks formed in the first place. We have to go back to 1907 and the panic US stock market had during that time, also known as Knickerbocker crisis. It was a severe financial crisis characterized by a series of bank failures, economic turmoil, and liquidity crunch. Some of the reasons that led to this crisis was weak financial infrastructure during that time, and that led to a market decline of over 60% during this period. As the news of the stock market decline spread, depositors rushed to withdraw their funds from the bank, resulting in multiple bank runs. These bank runs led to severe shortages and forced several banks to suspend their operations and declare bankruptcies. Notably, one of the prominent financial institutions called Knickerbocker Trust Company has collapsed during that time because of severe liquidity crunch, and hence the crisis during that time happened is called as Knickerbocker crisis. The panic of 1907 played a critical role in shaping public sentiment and the subsequent push for the establishment of the central banking system. The crisis underscored the importance of having a central authority to provide stability and prevent future financial panics, ultimately leading to the formation of Federal Reserve in 1913. The panic of 1907 played a critical role in shaping public sentiment, and that further led to the establishment of central banking system. In India, though, under the British rule, there was a committee formed under the name of Enlightening Commission in 1926 to monitor the India's currency and banking system. The commission recommended the establishment of central bank in India. Based on the recommendations of the Enlightening Commission, the Reserve Bank of India Act 1934 was enacted by the British government. The Act provided the legal framework for the functioning and the establishment of Reserve Bank of India. The formation of RBI is aimed to centralize and regulate the banking system in India. Initially, it was private held during the British rule. Later on, when India got independence, the RBI was nationalized under the government of India. Central banks are established mainly to address specific economic challenges and also to maintain the price stability and the monetary stability in a particular country. One of the main role of any central bank across the world, if you take that is functioning in any country, is to maintain the price and monetary stability in that particular country and ensure the smooth functioning of the financial system. And while doing that, it also needs to ensure that the economic growth of the country stays in place, because if you tinker around the monetary policy too much, it will have a direct impact on any economic growth of the particular country. So it's a delicate balance between economic growth and also ensuring that the inflation is not going out of the whack. And the second role is regulating and supervising banks. They are the boss of all the banks that we have in the country. They have the regulatory and supervisory powers of all the banks that are present in the country. So in other words, they establish the rules and regulations to promote the safety and soundness of the banking system. They're also considered as lender of last resort to any commercial banks, providing liquidity during the times of financial stress, and also by offering emergency funds to maintain and stabilize the financial institutions. Central banks help prevent systemic failures and maintain the stability of the banking system. This is one of the important roles of a central bank. And the fourth one is basically managing the money supply. Central banks literally have the power to create money. So we have seen in many crises that happen, whether it is in recent to 2020 COVID crisis or go back in time in the 2008 financial crisis, central bank can literally print the money out of thin air. They also have the power to suck the liquidity out of the economy in case if they find the inflation is running too hard. The other one is exchange rate management, because this is actually very important for a lot of emerging economies like India, because trade that happens in US dollar, and you need to ensure that the exchange rate between say USD INR should not fluctuate too much, should not have that much of volatility in the market. Otherwise it will create a lot of havoc in a lot of businesses. The last one is basically government banking services. Just like every business has a banker, for government, RBI acts as a banker whenever government want to raise any debt, whether it is in the form of government bonds or treasury bills or anything of that sort, or if government wants some kind of money, RBI provide that as a lender of last resort. A central bank literally has many superpowers. They can literally create money out of thin air. But to curb inflation, they have only one tool at their disposal, that is interest rates. The central banks generally give guidance in terms of the inflation rate that they are comfortable with in maintaining price stability. In India, for example, the RBI is comfortable in maintaining the inflation rate between 4 to 6%. And when you take an example of US, the Federal Reserve wants to maintain the inflation at 2% or so, something thereabout. One of the main arsenals that central banks have to curb inflation is interest rates. Of course, they also can do something on the money supply and other things that they can do to curb inflation. But without rising interest rates, especially in the scenario like what we are seeing in US and Europe, where the inflation is almost multi-decade high, without rising interest rates, there is no way that central banks can curb inflation. Imagine an economy experiencing high inflation where the prices of goods and services are increasing rapidly. To combat this, the central banks rise the interest rates. Here is a quick explanation of how does it work, how does it percolate in the entire system. When the central banks rise interest rates, borrowing costs for businesses and consumers increase. For example, if the interest on loans increase from say 5% to 8% or 9%, the borrowing becomes expensive, and the demand for a housing loan or an auto loan generally decreases, which in turn will percolate in the economy to reduce the demand for other sectors as well. Reducing borrowing and spending. As the interest rates rise, borrowing becomes less attractive for businesses and consumers. It becomes more expensive to finance investments, purchasing or take out loans for big ticket items like homes or cars. Consequently, both businesses and individuals tend to reduce their borrowing and spending. So this in turn leads to decreased demand. So with reduced borrowing and spending, overall demand for goods and services in the economy decreases. When demand slows down, businesses have less pricing power and they may be forced to lower the prices to attract customers. As a result, the upward pressure on prices leading to the moderation in inflation. So when a central bank rise any interest rates, that usually dampens the sentiment in terms of the excessive borrowing and spending. That automatically results in the reduction of the demand. Through this mechanism, a central bank's aim is to curb inflation and get it closer to their targeted rate. It's important to note that any interest rate changes takes its own time to manifest and percolate in the economy. It doesn't happen like switch on and switch off, because a lot of these things are related to one another. There are other factors in the economy which may affect the inflation as well, such as the wages, productivity, and external shocks can also influence the inflationary environment. One of the important roles of a central bank is to carefully analyze the economic condition of a particular country and adjust the interest rates accordingly to ensure that the delicate balance between the economic growth and also to maintain the price stability in such a way that the inflation is within their target band. I hope this video is useful. In the next inflation series part, I want to talk about the current inflationary scenarios that we are seeing in US and Europe, where most of the inflation rates are multi-decade highs. And I want to explain what are the reasons that cause this inflationary scenario and how long this inflation can last, with some historical snippets of 1970s that the US is faced. So stay tuned next week. This is Pawan. Thank you very much for watching. I'll see you in the next video.